important subjects that are of use to us when we consider the future of mutual fund investing in India is real estate mutual funds. The second is passive investing or index mutual funds. Today, not at all popular in India. In fact, real estate mutual funds in their true sense simply do not exist in India. Index funds do exist but are not popular. We'll get into that, the reasons for that a little later. But it is very, very important that we understand what's going to happen in the next decade or two, especially people who are going to be investing during that period, or people who are going to be dependent upon their mutual fund investments in that period for their retirement income. Real estate we already tackled in the last class. Very briefly, there is a lot of headache in managing, owning, administering physical real estate. In my entire career, I have never been in real estate as a business. Neither do I want to be. But since a lot of clients consult us on various problems of theirs, which many times are totally outside the purview of our own work, I have virtually been compelled to make some little study of things like the Karnataka Apartment Ownership Act, a little bit of real estate, and about a couple of years back, I was virtually forced to even write a small 4-page paper on my views about real estate, both as a means of consumption, that is if you are using it to run your own office or as a residence, as well as real estate as an investment. When you invest in real estate through a mutual fund, a number of these problems are taken away from you. For you, it is almost a financial investment in a physical asset. Now, unfortunately, there are a lot of murky areas in India in real estate. The recent Real Estate Regulatory Act has tried to address some of the important issues. It cannot, by regulation, you cannot cure everything. Things may improve, but it will take time. Until then, I'm afraid no mutual fund will really come out with a genuine real estate scheme. At the same time, we should try to figure out how real estate mutual funds work abroad. And the number one country to understand this is the United States. In fact, there are so many real estate mutual funds in the United States that Vanguard Mutual Fund has something called the Vanguard REIT Index Fund. What Vanguard does, it has not even fashioned a real estate fund. It simply has invested in all the real estate investment trusts, as they call them, the REITs, and created an index of them. So just by even a very token $1,000 investment or $100 or $200 systematic investment per month, you just invest in all the real estate, all the main categories of real estate in the United States. Now in India, we have a long way to go. But when they do come, they will be structured as follows, at least as per the present thinking, the present rules that are in force. Mutual funds will be allowed to invest only in something called yielding real estate, which means I cannot buy a vacant plot of land which is not going to earn me anything. It has to be something that yields rental income. It can be a residential block of apartments, a whole commercial building or buildings. To some extent, they will be also allowed to finance developers, in which case they will be earning an interest on it. They will be allowed to invest in, to some extent, small extent, shares of real estate companies. But essentially, there will have to be a major element of purchasing, holding, yielding real estate, earning the rental from it. There will also be conditions that a certain percentage, the major percentage of the rentals that they receive have to be distributed back to the unit holders in the form of dividends and so on. And the same rule applies even in the United States. All this is right thinking because real estate is very dicey. Just holding an asset and depending only on the changes in the asset price is not a very wise thing. Yield is something real, that is income. A focus on yield, a focus on growing yield, a focus on growing income as the days go by is very important. And when that is coupled with the kind of appreciation that real estate can give in the long term, that transforms real estate into a viable, into many times an attractive investment. So just to add to where we stopped in the last session, this little conclusion about real estate, watch for genuine real estate investment trusts or real estate mutual funds, they are called in India, REMFs, when they start functioning in India. Let's turn to the other and even more important aspect that investors in India are either unaware of or they neglect it totally because right now it's not too attractive. And that is the importance of passive investing or the importance of index funds. We'll start with a saying, if you think you're smarter than the market, just remember, to the extent that a fool knows his foolishness, he may be deemed wise. A fool who considers himself wise is indeed a fool. The hidden lesson here is that we have to work within our limitations. And when you embark upon predicting what's going to happen in the financial markets, many times that's a fool's errand. I will show you repeatedly in today's class with various examples. There are a lot of not intelligent but hyper intelligent people engaged in the same task of picking winners. The fact that they do the same thing, whatever advantage they have quickly disappears when other people also start emulating them. Therefore, it is very, very difficult to consistently outperform the market. Ultimately, the market may be right or wrong, but it is the market and it is the final arbiter of securities prices. This is something that we have to be aware of and more importantly, that we have to accept. There is wisdom in such acceptance. So when we realize our limitations, when we fashion our strategies to play within those limitations, we can come out with pretty good investment strategies. The consistently superior performer is the market itself. It is the market that gives you the returns, not the fund managers. It is very easy to claim credit. The fund management industry is very famous for two things. When the market goes down, when we all have losses and negative returns, it's nice to blame the market. On the other hand, like we have today's situation, there's nothing to do with the market. It's my magic that gave us the returns. So this is what happens in fund management. Michael Lebbeef, a disciple of John Bogle, says, invest your time actively and your money passively. I have seen so many people who spend so much of time on investment. Now, I myself have been an investor for 3.5 decades. My investment is something that is in the background, does not require 1 minute of my time per day. There's a process set. The investments take place according to that process. Once in a way, we may do a review. Our reviews, since we are in touch with things and most of reports today are available at the press of a computer keyboard, may not take more than 5 minutes every quarter. So in a year, I very much doubt whether I will be spending more than half an hour on a review. I do the review. It's not that I don't do the review. But the strategies are set so in such a simple manner that it doesn't take much time to do a review. So we are at any given time supremely aware of exactly where we stand in our investments. You ask me now and I can tell you pretty accurately what are the categories, why we are there, what are the present values, what are the plans for the future, everything. I can tell it to you because I am aware, but I do not obsess about it. When I am in my office, my focus is on my work, not on my investments. Many successful investors have the same attitude. Investments are not something that constantly bother them. Investments are something that keep happening in the background. That releases the time and energy we have at our disposal for work that is economically productive. And economically productive work enables us to earn, to have a surplus which can be saved and invested wisely. So it's a virtuous cycle. The less you have to bother about your investments, the better you work, the better you focus on your work, the more you earn, the more productive you are, which leads to greater surpluses for investment. That should be the way we go ahead. Let your life be exciting and your investments boring. Good investments are boring, as George Soros said. George Soros himself is somebody who has lived a very, very exciting life in the markets. But when he advises investors, the advice is correct. Good investments are boring. And we will be seeing a lot of boring things today as we move along. Warren Buffett. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Most people are not aware, and they constantly get shocks, that the world's most successful so-called active investor advocates investing in index funds. So today I want to tell you Warren Buffett's own philosophy. Warren Buffett did start life out as an investor. But today he is not an investor. He is the first person who will admit that he is not an investor. He is a hands-on full-time businessman. He owns companies. He takes an active part in the management of companies, which we as common investors do not do. We may be having 100 stocks in our portfolio. We do not take part in the active management of even one such company. Forget that. Almost every day in my mailbox there is, you can vote on this resolution, you can vote on that resolution. And even if you just vote on a resolution, believe me, you are taking a little bit of passive role in voting on a company's resolutions. It's not even active management of the company. Even that we do not do many times, because it's not possible when you get so many of these mails and to study various resolutions. We rather would depend on diversification to see us through and selecting the main companies. Warren Buffett is advising investors that most investors, and the curious part here is both institutional and individual. Now, institutional, you'll be really shocked to know that in the United States, institutional, like the pension fund managers, people who have got access to tens, if not hundreds of billions of dollars, in one or two cases maybe exceeding trillions of dollars. Now the people managing these funds are extremely highly educated, extremely knowledgeable. The percentage of their money that they put into passive funds, not actively managed, is far higher than the percentage put into passive funds by individual investors. Long back, that percentage exceeded 30. Today, almost 40% of institutional funds in the United States are passively managed. At the individual level, it is creeping up towards the 20% level. From nothing, of course, a long time back. So, he says both institutional and individual will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the great majority of investment professionals. So he says you've got a very good chance of beating most of the industry's professionals, forget about other investors. And for people who refuse to believe, when he made this first comment. It was not yesterday or day before. In 1996, if I'm not in the annual report of Berkshire Hathaway, very easily verifiable because all these annual reports are available to you free of cost on the Berkshire Hathaway website, www.berkshirehathaway.com. He has repeated this many times, but this was the first time it appeared. He is advising investors, advising them correctly. He goes further. Charlie Munger and I would be glad to take on any money management organization in the world managing more than 10 billion US dollars. And we would be willing to bet that their aggregate investment performance will be poorer than a no-load, very low-cost index fund. If you look at this slide, I only wish I had got the 10-year returns. Let's understand what we see here. Mutual funds that trail the benchmark index in the US. That means mutual funds, the percentage of mutual funds that do poorly, worse than the index fund. They have taken a number of categories from large cap, mid cap, small cap, international, emerging market, bonds, municipal. And he has taken across 1 year, 3 year, 5 years. As you can see here, in the large cap, where the markets are the most efficient, whether it is 1 year, 3 year or 5 years, the majority of the funds are trailing active management. A simple computer program that allows you to just go with the index, mimic the index, is the active funds are trailing these. If you go to mid cap, more or less the same story. As you go to some of the categories, you'll see here that the active funds are doing better than the passive funds. For example, here, seriously better in a 1 year horizon. But as time passes, this is important, as time passes, as you come to just 5 years, you don't find a single category where active management is doing better. In fact, the standard pretty stable figure is that in a 10-year horizon, in this category, which is the most efficient, 80% of actively managed funds perform worse than the index. So, when you are investing in an active fund, you are paying a higher fee. You are paying a fund management fee. You are paying not for performance, but for non-performance. This is what it amounts to. For the extra payment that you make, you would expect extra service. You're not getting it. You're not getting it. Let me give you a passage from James O'Shaughnessy. First, let's see what he's saying, then I'll tell you who he is. James O'Shaughnessy says something very significant. What he says is, consistency is the hallmark of great investors, separating them from everyone else. Consistency. If you go back to a slide we had in the last session, Stay the Course by John Bogle. Stay the course. Consistency is the hallmark of great investors, separating them from everyone else. It's not financial knowledge. It's not academic brilliance. It's consistency, perseverance. If you use even a mediocre strategy consistently, you will beat almost all investors who jump in and out of the market, change tactics in midstream, and forever second guess their decisions. Consistency is important. If you remain with a strategy, it will deliver. Look at the S&P 500, he says. That's an index. We have shown that it is a simple strategy that buys large capitalization stocks. Yet this one factor, rather mediocre strategy, still manages to beat 80% of all actively managed funds because it never leaves its strategy, not because it's good. It isn't. It's not good. It's consistent. S&P 500 25 years back was the top 500 large cap stocks. Today, the top 500 large cap stocks. 30 years from now, the top 500 large cap stocks. That's all. Stocks may change. Strategy does not change. If we have understood this, we will understand a lot of why does it come out with this kind of performance, because it never leaves its strategy. That's all. There's nothing else. James O'Shaughnessy, let me tell you who he is, what's the work he's done. He's written a book called What Works on Wall Street. If you are someone who's like a CFA, Chartered Financial Analyst, who loves researching, equity research, etc., etc., it's a good book to buy and read for the sheer cerebral work that has gone into the analysis. And very briefly to tell you who O'Shaughnessy is. He was the first person to gain access to something called the S&P CompuStat database. It's one of the most comprehensive databases that you can ever have about stock prices, running across decades. And very few people have ever been able to make use of the information here for analysis. O'Shaughnessy was one of the lucky people who managed it. And using computer simulations, O'Shaughnessy backtested a variety of trading and investment strategies. Now, in that process, of course, this is knowledge by hindsight. He went back delving into it, but it was one of the finest studies ever made in an effort to understand what works in investing. That's why the title of the book, What Works on Wall Street. Now, of course, everything you do these days has people who will praise it, people who criticize it, a lot of people who have criticized it. Some people have said, yes, there was merit in what he did. What has happened is, there were mutual funds who appreciated the kind of work he did. So these mutual funds started fashioning strategies based on what O'Shaughnessy said works in Wall Street. Now the results were mixed. There were times they did badly, there were other times they did better. We also have to understand that if more and more people start using the same strategies, the advantage will disappear. But whatever it is, the work done was excellent. I have read the book myself and I certainly would appreciate the kind of work that has gone into his book. But at the end of everything, this is important. What does O'Shaughnessy advise? See, here the problem is, if you see the last point here, it may work. What he says may work. We may get returns that are better than passive investing, better than the index. But the effort needed to capitalize on these strategies cannot be undertaken by normal people. It's not just what's the best. It is also what is doable. And doable by normal people like us. So he advises, if try as you might, you can't stick to a strategy. Put the majority of your money in an index fund and treat the small amount you invest in story stocks as an entertainment expense. So it's very clear about what an investor should do. And this coming from a man who is a genius, a wizard at statistics, a wizard at research and analysis, and a person who was lucky enough to have access to the richest database of securities prices ever. Burton Malkiel, an investor with $10,000 at the start of 1969, who invested in a S&P 500 stock index fund, would have had a portfolio worth $422,000 by 2006, assuming all dividends were reinvested. A second investor, who instead purchased shares in the average actively managed fund, would have seen his investment grow to only $284,000. And the main reason is not that the people who are in active management are fools. No, they are not. In fact, they are far above average in intelligence. The problem is the costs. And difference in costs over time, we are talking 1969 to 2006, so that's 3-4 decades. Over time, these differences in costs result in a huge variation in the end capital. That's why that 422 versus 284. Studies have shown that in about 35 to 40 years, a 2% difference in return. For example, if you're getting 12%, in another investment you get 10%. But this continues over 35, 40 years. The difference in end capital will be double. If you're getting, 10 lakhs in one, you will get 5 lakhs in the other. That's a huge difference. But the rate of return, the difference in the rate of return was only 2%. So John Bogle says, stay the course. No matter what happens, stick to your investment program. I've said stay the course 1,000 times, and I meant it every time. It is the most important single piece of investment wisdom I can give you. So I wanted to drive home this point, and this point is worth driving home under any context, especially in the context of investing. Passive active is one argument, consistency in investment is totally different. Now, when you're consistent, always go for the best choice, the most consistent choice. Let's go further. Today, this particular topic has become very, very much of hot news for people in the financial service sector. A lot of other people do not know about it. There's a website called www.longbets.com. This website is exactly what it says. If any two people want to challenge each other with differing points of view and want to place an official bet, but the results of that bet is not like a Wimbledon match. Maybe in 3-4 hours you will get to know the result. No, the result will be only known after several years, or maybe a decade or two. Then this website gives an opportunity to record the terms and conditions of the bet, to record who the parties are, to record what the bet is, and to follow the progress across time, and finally declare the winner or loser. One such bet, which is on longbets.com, you can go and see it, or you can just Google Warren Buffett or the $1 million bet, and you'll get enough data on it. But let me tell you briefly what it is. It's a 10-year bet, and fortunately for us, we have finished 9 years. It's popularly called the $1 million bet. This is Warren Buffett's 10-year wager that the S&P 500 would outperform a sampling of hedge funds. So on one side you have Warren Buffett, on the other side you have a bunch of hedge funds. The terms of the wager are as follows. Buffett is betting with his own money, not the money of his company. He is betting on the stock market performance of an S&P 500 index fund of Vanguard mutual fund, the standard mutual fund in the US, Vanguard S&P 500 index fund. The other party to the bet is Protege Partners, a New York money manager. Protege is banking on 5 funds of hedge funds carefully picked at the start of the bet. So they are very carefully picked, the 5 best possible hedge funds you have. The names of these 5 hedge funds and investment portfolios have never been publicly disclosed so that nobody can influence them. Only the parties to the bet know which funds they are. The proceeds of the bet will go to a charity of the winner's choice. So not the parties involved, but it will go to charity. In the first year of the bet, the hedge fund combination did better than Warren Buffett's investment in the Vanguard S&P 500 index fund. In that year, that was the year of the global financial crisis, the Vanguard index fund fell 37%, minus 37. The hedge fund portfolio fell only 24%. In the next 6 years, however, the Vanguard index fund did better than the hedge fund combination. In the 8th year, which was 2015, the hedge funds did slightly better, gaining 1.7% versus 1.36% for the Vanguard S&P 500 index fund. In the 9th year, the Vanguard S&P 500 index fund resumed its outperformance. 9 years have passed. Vanguard's 500 index fund, as represented by its Admiral shares, is up 85.4%. That's the portfolio carrying Buffett's money. Protege's 5 hedge funds of funds, the bet users, are on the average up by 22%. And these are run by brilliant people. That is run just by a computer program, tracking the S&P 500 index. As O'Shaughnessy said, a mediocre strategy. Results after 9 years in compounded annualized growth rate. Vanguard is 7.1% CAGR, fantastic return over this period of time when people were killing for 0.5% return. Hedge fund is 2.2%. The true winner of the bet will of course be the charity to which winnings of the bet will be donated. The minimum payment guaranteed is $1 million. Buffett and the others said, regardless of what the values are, we take those values, I make up the rest, and 1 million will go to the charity. In the single year that remains for the bet to conclude, it would take a miracle for Buffett to lose, given the kind of lead his passive, dumb investment has now established. And in Warren Buffett's own will, he has publicized one piece of advice that he has given to the trustees of the will. What we call executors here are called trustees. They are the people who have to give effect to the provisions of the will after his lifetime. And this is with reference to what he is leaving to his wife, to that money. He says, my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. So the world's greatest so-called active investor is giving the common investors a lot of advice, and that advice is just invest passively. Let us pause here for a moment and try to view things in the Indian context. Indian stock markets have several attributes, some of which we can be genuinely proud of. The oldest markets in Asia. The second oldest is the Tokyo Stock Exchange. The oldest is the Bombay Stock Exchange. Trading in Indian stocks has gone on for more than 200 years, even back during the British times. At the same time, the fact remains that even today, India is not, it's a growing player, but definitely not an earth-shaking player on the global financial markets stage. Indian markets have certain characteristics. They don't have depth. There is a lot of speculative activity in a few stocks, maybe 50 to 100 stocks, especially the stocks where there are derivatives contracts, futures, options, trading is permitted. A lot of people use it because there is no legalized betting in India except maybe for a little bit of horse racing. There are no public casinos. So these are used as casinos. The futures markets, the options markets. The whole idea of investment is perverted. So what happens is, reasonably good liquidity in these kind of stocks, but the activity is not investment oriented. And there are a huge number of stocks where liquidity is very, very poor. Not only that, we are living through times when the indices are at their peak. But if we go into, let's say, a recession of 2 or 3 years, for whatever reason, you will notice that many times even in the blue chip stocks, liquidity shrinks terribly. A normal investor buying their 100, 200 stocks, you may be able to do it. But an institutional investor will find huge impact costs if they have to come out and buy, let's say, 50,000, 1 lakh, 2 lakh stocks. They'll have to then spread it between the markets, between brokers, over several days perhaps. It's not easy. Or they'll have to negotiate some kind of a bulk deal from another bulk seller, which is not very easy to do. Also, despite 2 decades or more of SEBI, 2.5 decades actually, 1992, Indian markets are still not efficient. There's a lot of inefficiency in Indian markets. Putting all these factors together, we have seen good performance from a large number of leading Indian mutual funds, especially the equity funds. A lot of them have consistently beaten index funds. That's the first point. The second point is, one of the reasons, or the main reason, why index funds outperform actively managed funds in the United States is simply because their costs are so low. This whole shift of outperformance started in an era where index fund expense ratios dropped to something like 0.1, 0.11, 0.12%. The active management fees were 1.4%, etc. Today, because they are not able to withstand the competition from the index funds, the active management fees have dropped to something like 0.7, 0.8% per annum in the United States. And the index fund fees are still, many of them are below 0.1%, 0.09, 0.08, etc. But in India, most of the index funds have expense ratios of about 1%. Active management about 2.5%. So whereas there we are having a 10%, it's 10% of the active management fees. Here it's about 40% of the active management fees. Second thing is, neither the mutual funds nor investors nor investment advisors are really focusing on Indian index funds, because somehow they are not popular. At no stage are they popular, neither with investors nor others. That does not mean there cannot be a paradigm shift in the years or maybe decades to come. As the markets move towards efficiency, all markets move towards efficiency, because there is the underlying acceptance and knowledge that ultimately when markets become more and more efficient, it is fair to all stakeholders. So although there are people who have got a vested interest in keeping certain markets inefficient, they can manage to do so for some time perhaps, but before long the regulators get into the act, the government gets into the act, investors become more knowledgeable over a period of time. If you look at the United States today, 2 or 3 tremendously important shifts have happened in the last 2 decades. One is, when you look at the new inflows into investment, new money coming into investment, the overwhelming majority of this money is flowing into passive investing. Second, there is an equally discernible and significant shift from old money, money that's already there for the long term, moving from active management to passive management. And don't be surprised if this thing is going to happen in India, say 10 years from now. That is why I said, let me tell you about all these things. Let me give you, we can always learn from other people's experience, other countries' experience, other markets' experience, so that we can slowly prepare ourselves for what is going to come in the future. So that was about active and passive.